Managing Partner, Gaja Capital, Deepak Gowda, Partner Asset Capital, Sumit Keshan, Managing Director with Pro Consumer Care. I take pleasure in introducing Kaushalya Venkatraman, partner Chandayok and Mahajan. Kaushalya has over 12 years of experience in practicing corporate and commercial law. Her practice focuses on both general corporate advisory as well as on transactions with key focus on private equity, venture capital and M&A. In the general corporate advisory space, she routinely advises clients on a wide array of matters from incorporation, commercial contracts, foreign exchange management. In venture capital and private equity space, Kaushalya has advised clients from seed round to the exit of promoters, financial investors to a strategic buyer. Additionally, she has experience in advising clients in pure play and the distressed M&A space. Over to Kaushalya.
Thank you so much. We would want to keep this panel short and sweet. I think that's the sentiment that we want to say, because this is like one of those panels where you had your there's lunch coming right up, so we sort of keep it short and sweet. So I leave it to the panelists to introduce themselves. We'll start with you, Sumit.
So with Keshan, I'm managing partner of Pro Consumer Ventures. We have a VC fund dedicated to startups in consumer space in India and Southeast Asia.
I'm Deepak, partner at Ascent Capital. We are a growth stage private equity fund. We invest across 4 sectors: healthcare, technology, financial services, and consumer. Currently on our 3rd fund. I've been in business since 2008, which is 15-16 years now. So invest in fast-growing companies at Series B and higher in the tech parlance, but also companies which have found a product market fit and looking at growth capital. And we typically try to work along with entrepreneurs. We see entrepreneurs as the domain experts, and we as the complementary team that can help them realize their ambitions, and we are the ancillary beneficiaries of whatever they achieve. So that's the way we look at it. And I mean, happy to be in the panel, and hopefully we'll get some insights.
I'm Imran. I'm from Gaja Capital. We've been in business for 20 years. We focus at the growth stage of tech and tech-enabled businesses. We think of ourselves as scale-up specialists as opposed to the venture ecosystem that focuses on startups. So we invest in companies that are roughly $10 million of revenue, and we help them scale to 100. In the last 20 years, we've done a mix of different kinds of deals. Since 2018, more tech and tech-enabled at the Series C stage. But we've also done mid-market buyouts. We've invested in banks. So we've had quite a variety of different investments. We're currently actively deploying from Fund 4, which is about a third deployed. And we're based in Mumbai, but we think of Bangalore as our second home.
Great, lovely panel. So I think from the beginning of our conversation this morning, where Mr. Shibula spoke, I think the main theme has been, I suppose, capital markets, right? At the beginning of my career, I used to be a capital markets lawyer, so I used to do 36 hours straight, right? And at that point in time, the landscape was dominated by promoters and family-run businesses. But now we're seeing an entire sort of sort of a shift from promoters to founders. And in that context, especially for the growth capital investors, are you feeling the heat now that the IPO market is really taking off in India? How do you see that affecting sort of the decision of the founders to sort of take capital from growth investors? Vis-a-vis, how do you see that playing out for yourselves? Are you a competitive? Is that become competitive for you vis-a-vis the IPO market? How do you see this playing out? Deepak.
Yeah, I mean, I think the way we see it is a little bit differently. it's great that IPO markets are open. Typically in India, I mean, we always, here in 2007, everybody believed that IPO markets would be open forever. So that is the euphoria that we are seeing right now. But in the space that we operate in, I mean, if the IPO markets stay like it is, with domestic investor participation coming in with a lot of foreign interest as well, it's good for us because ultimately the stage that we invest in, the companies are still not ready in terms of systems and processes. As you know, since you're an IPO lawyer,
Was the operator.
So the reason why you left was probably because of the rigorous process that's there. So, I mean, if you read the headline papers, you figure out that it is very easy. You just file a DLHP and it gets listed. But we know the pain that is involved in getting a company IPO ready. And if you look at it, a lot of the founders also know it as well. So it's good to onboard somebody who has some experience and is able to navigate that journey along with the entrepreneur. So I think it's a good thing because although valuations, obviously, people are benchmarking it against the public market valuations, but the good news is that there are not too many investors who want to wait for 2 or 3 years. Everybody wants instant liquidity in the current market. So that works well for us because those companies are getting left out. So it's either a feast at one end for companies that are ready for an IPO, or famine at the other end for companies which are 2 or 3 years or maybe 4 years out of an IPO. So we fall into the latter bucket. So it's good, I mean, both from a deal flow perspective as well as from a liquidity perspective. And I think it also bodes well for the country, although people are going to get hurt in this rally, definitely because, I mean, if you look at some of the quality of the companies that are coming out, questionable. So ultimately, even if you look at the dot-com bubble, there were like thousands of companies that got formed, but that is where Yahoo emerged, Google emerged. So a similar kind of thing will happen in the IPO market as well, we believe. And it's good that retail investor participation is going up. I hope they don't lose too much money, otherwise they'll never come back, which is a 10-year cycle that we typically see in India. But hopefully this time is different. We don't know.
We've seen this for 20 years. We believe that India has changed orbits. We think sometime in the next 6 to 7 years, India will be a $100 billion private equity and venture capital market. And if we hit 100 billion, by the way, we hit 65 billion in 2021, so we're not that far away. And at $100 billion, you're a mainstream private equity and venture capital market. Not very different from the US, in some respects similar to China. So the fact that IPO markets are open, the fact that there are many types of financiers available for different stages, for different solutions, not just IPO markets, but you have crossovers, you have hedge funds, you have secondaries, you have different types of financiers, I think is a sign of maturity. And that's a very, very positive sign. In the first decade of our investing, it was never about, to take a swimming analogy, it was never about how masterful your strokes are or how many swimmers you're competing against. The problem was, after every 2 or 3 years, they would drain the pool. And so when you have a liquid, deep, broad market like we have today, that's a great sign for this machine to work. So you have deployment of different types, you have exits of different types. So the short answer is, I think it's a very positive sign and a sign of maturity. And while we're looking at IPO markets for exits, there's no denying that, for some, from a deployment point of view, IPOs will seem like a competition for us, but we're big believers in investor company fit. Just like you have product market fit and founder market fit and so on, you need, like Gaja Capital has focused for 20 years on only one problem, which is the scale-up problem. We don't think IPO investors are staffed to address that problem. We don't believe that the venture capital ecosystem is, skilled for that problem. And so we think that there is enough of a market for investors that specialize in doing one thing over very long periods of time.
Right. So from your
And
perspective,
if I may add on this topic, I think having more and more exit opportunities is important for the VC and PE ecosystem. And in the last 3-4 years, if you see, exits have improved, which gives confidence to the LPs, it gives confidence to the whole ecosystem as a whole. This is not seen in Southeast Asia. that when we invest there, we find that the exit opportunities are quite limited. Secondly, a couple of our portfolio companies probably will go IPO in the next 2 years. Today itself, I got a call from someone saying that they are looking at an exit, and we are strategic. Would you like to buy an M&A, which is what I also do. Companies are not built for strategic sale for various reasons. It may be a house of brands, it may have different categories which a certain company may not be interested in. And hence IPO market becomes very important from that perspective. So I think having more exit opportunities is very important.
Right. And to Sumit, I have a question. I understand that Wipro Consumer Ventures operates and co-invests with other private equity and venture capital investors, right? So how do you fare? How do you look at yourself vis-a-vis financial investors? Like how do you make that comparison?
So, see, essentially we as a fund, we have a fund under Wipro Consumer, which is a business, and our thesis is to invest. So we try to act like a VC as a financial investor, and it's not that we have done individual investment, we have led investment, we have done single invested in certain companies, we have done about dozen investments as of now. So our thesis is kind of broad-based in that sense. Is that the question?
Yes, that was the question. Yes, thank you. So I guess I go on to some common questions for the panel. Do you see a difference in how growth capital is shaping up tech versus non-tech? Because I know that some people make a distinction between investing in certain kinds of companies. They classify them as tech, non-tech, consumer. So do you see growth capital sort of shaping up differently for different segments?
See, I think for us, there are maybe three distinctions. One is tech-enabled, one is tech, and the other last one is essentially the regular tech farm. Although we use tech is not going to change the game for them. So tech is essentially for us where the revenue is coming from a sale of a technology product, right? So now if you look at it, a lot of people are talking about AI, SaaS. I mean, obviously SaaS was the flavor of the season a couple of years ago. Now everybody says SaaS is dead. AI is going to eat everybody's lunch. So, I mean, in India, if you look at it from a technology standpoint, actually, we were just discussing before the panel as well. The scaled-up tech companies are few and far between. Especially the private equity venture capital system is not geared up for services right now, right? Nobody's looking at the services companies. Nobody knows whether the headcount will stay, whether the margins will stay. So nobody knows that. But that might be the opportunity because any corporate that is looking at a Fortune 500 or even a Fortune 1000 companies are looking at how do we bring AI into their corporate setup, and that kind of expertise is still not there not just in India but across the world, right? So that is something that is interesting for us. AI, ultimately there are large language models and the foundation models which requires billions of dollars of capital. And it's like maybe 15-year game. But for private equity investors such as ourselves, which have a holding period of 5-6 years, that might not be something that is relevant. The second part of AI is essentially building an application on top of the models that are there, and also doing small language models. So those are probably two opportunities that are there. But as growth investors, we have not seen at least we have not seen too many scaled-up companies in that domain. So hopefully it will come during the investment period of our new fund, but currently, they're still building it. And tech-enabled, like Sumit's, everything is tech-enabled now, whether it's consumer, whether it's financial services and others. But tech-enabled is where we are selling a different product, but technology is enabling that sale or making it better, right? And the final part of it is essentially the regular run-of-the-mill manufacturing, pharma. Those companies, I think have fallen a little by the wayside, which is where I think there are opportunities there as well. Hospitals and pharma companies and others as well. So I think, again, it's all a cycle. You have to choose which part of the cycle you want to participate in, because typically our holding periods are 5-7 years. So we are looking out 5-7 years down the line rather than today to make a decision. So that if you catch it at the right cycle, that cycle will come eventually. So that's what history has shown. History tends to repeat itself.
And you and Ram?
Thanks, Rachel. I was just telling Sumit that I worked in Wipro Technologies in '97, and I was doing some analysis for another panel, and I discovered that if you look at 20 years of IT services in India, the revenue per employee has not changed. We basically scaled to a $250 billion industry, and hats off to that. But by throwing people at the problem and rupee depreciation at the problem, right? And not to take away from the wonderful work that's gone on, but the future of India is not that. The future of India is to build products in India that will compete against the best in global markets. That is the story of SaaS. That is potentially the story of AI products as well. And so we've, since 2018, started investing in pure software businesses, software product companies. And this is fundamentally different from anything out there. So, of course, I agree with you, Deepak, that now technology is a horizontal. Every company needs to have tech. Like, name a company that doesn't have tech. So there is an acknowledgement that it's a horizontal, but equally software businesses just are fundamentally different in the way they are financed, in the way they scale, in what you can do with them after you invest in these companies. So we've invested in a couple of SaaS companies, Lead Squared, Signsy. Our thesis was a little different. We were looking for, and perhaps contrarian 5 years ago, we were looking for SaaS companies that addressed Indian markets first, and then scaled to the US, which is the largest SaaS market in the world. And 5 years ago, this was a contrarian bet. Today, people talk about Indian TAM being in billions of dollars. At that time, we used to talk about hundreds of crores. And our view is that over the next decade, the Indian market will be large and deep enough to support many, many different types of SaaS and AI companies. And our thesis remains the same. We're looking for companies that have product market fit in India, but then on the back of those robust cash flows and product market fit to help them scale to global markets where the US is the largest and the deepest.
And the fact is that, or generally, on your point, there are not many product companies which have really emerged from India yet, and this is what we would like to see. We have very strong R&D centers in India. The kind of work that Google India and Samsung R&D does is crazy. A lot of the stuff that we see on our phone actually is developed by our teams in India. But really, software products coming from India is still it's slow. I think that's something that you are hinting at, and that's something that needs to happen.
And what do you all feel about certain sectors which have received disproportionate funding? We spoke about AI, but what about quick commerce, right? Because that seems to be the theme that VCs seem to be lapping up on. What are your thoughts on that?
We've invested in an e-commerce logistics company called ExpressBees, and we're very happy with that investment. And the thesis of ExpressBees was that logistics is a very specialized field. You can't serve a certain type of customer and pivot to serving the needs of an e-commerce customer. And quick commerce is exactly that thesis. They've found a niche. We are positively surprised by how fast they've scaled. We still have questions on the unit economics and how sustainable it is. But having seen a lot of these new age companies come in and with innovation disrupt the market, in the early stages it will appear as if it's a transfer of large sums of venture capital money to the ecosystem. But over a period of time, good founders, good teams figure out a way to create valuable, sustainable businesses, and I think quick commerce is here to stay. And it will also create a channel for a lot of D2C brands. I mean, D2C brands, until recently, people had started writing epitaphs on the D2C business, and I don't know, Sumit, if you have a view on that, but I think this channel has given them a lease of life.
Absolutely, I think it is really supporting the D2C ecosystem in a very large way. One of our portfolio companies, they get about 70-80% of revenue only from quick commerce. That's that important.
We we are a little biased because we were early backers in Big Basket. So quick commerce, obviously, if you look at Big Basket's history, the founders come from a deep retail background, and initially they were very skeptical about quick commerce, but kudos to some of the new entrants, and they've been able to at least change consumer behavior, whether it is through discounts or throwing money at the problem, doesn't matter, but now big commerce is the new norm, and everybody has to work around it, right? In terms of capital chasing, obviously people think that it's a very, very large opportunity, and because multiple categories can be added, and if like the dark store network, and I mean logistics becomes the most important part there, because I mean ultimately logistics and procurement are the only two nodes there, right? I mean ultimately, if India becomes very price conscious, I mean we used to have something where we used to scrape other websites in Gujarat to increase our dal price or decrease our dal price by 10 paisa, because otherwise there were customers were switching. But right now the thing is, if the procurement and logistics become the modes for these kind of businesses, but eventually, and it's a large category, and then it can also go deeper. But one thing I'm still worried about is essentially because Kiranas, which used to be the backbone, India is obviously a trader country and with small shops everywhere, right? And with quick commerce coming in, whether they will disappear, I mean, they're definitely getting affected. And as you know, the government, or I mean, the political class depends on these traders for their vote, as their vote bank. So I don't know what kind of regulations are on the horizon.
Yeah, that's actually a very interesting thought. Because quick commerce, I mean, a lot of Bangaloreans will be, vouching for the fact that it started with Dunzo, right? I mean, literally people would sit in the house and get Dunzo to buy them a packet of chips from a store which is literally 100 feet away, right? I mean, that was how it started. And I think some have fared better than the others, right? And it's not a new sort of thesis. It's been around, but it's just that some have practiced better than the others, right? That's just the sort of.
And the chances are that you start getting suitcases on quick commerce. That's my conversation this began, that it's moved from distress to convenience. And I think you're right at Bangalore, a lot of people would probably have moved a lot of the household purchases which they don't require right now. You're getting it 10 minutes, but probably you're stocking it. So he's saying, why don't we do suitcases? Since you please do it.
I think the next question is to the panel in general. Do you feel that with the Chinese funds sort of, not with the PM3 coming in and sort of the restriction on investment from Chinese funds, do you see, because after having spoken to a lot of VC firms, they used to see, the Chinese funds, especially Tiger, as their potential exit, right? That's where you would get the potential exit for them. Do you see that affecting sort of your ecosystem in some way? Do you see that has made an effect on how you make some investment decisions?
I think the exit of geopolitics, geo and politics, both aside, because I won't comment on that. But the exit of Chinese investors because of restrictions by the Indian government, and the exit of large tech investors that were writing term sheets a week, both of them have helped the ecosystem and helped investors like us, because it's taken some of the pressure off. It was a very frothy market. So in that sense, we've got a window for any one of us who has money to deploy. This is a great opportunity to cherry pick good assets, and some of the frothiness has gone out. But having said that, we must also, with humility, acknowledge that $100 billion of venture capital money has been invested over the last decade to solve a very crucial problem for growth investors like us, which is the sampling problem, right? And we must acknowledge and give them credit where it's due, that they did the power law investing to allow us to now, with them not in the market, to quietly cherry pick good assets. I shudder to think how our deployment strategies would work if they were very active. And I also think at some point we must open our borders. I don't want to comment on the politics of this. But like I said, again, to take the swimming analogy, you need a liquid, deep, broad market for deployment and exits. And I think in general that's a That's a good thing for India, and I'm grateful that right now they're not around.
And speaking of which, our firm has recently advised on getting some PM3 approvals for some Chinese investors, so they're not too far away. But what is your take?
I think you have to look at it with two lenses. One is the founder lens. Founders are definitely feeling the heat, right? Because ultimately Chinese slash the hedge funds, Chinese because of the geopolitics, but the hedge funds more because of their own challenges like a Tiger or a SoftBank or whatever. So there was capital that was available, especially for B2C businesses. And there was also expertise that was available because these firms had done similar investments in China and they had seen the potential of it, and so they were willing to go at higher multiples, which is great for the founders and also the early stage ecosystem. But that has vanished now. So the number of companies that are coming in the B2C space, depending on this capital being available, is probably a little bit smaller now. So from an investor standpoint, for investors such as us, Imran and Sumit probably as well, two things, right? One is obviously China has become uninvestable from a LP standpoint, right? So that money has to flow somewhere, hopefully to India, but it has not done so far. It's only gone to the US and probably some of it to Japan. At some point in time, India being a large market, some of that money will flow into, hopefully, to India, right? And the second part of it is obviously, we have time to do diligence, and there are companies. We're not putting the China multiples on India because we don't know whether India is going to turn out as China, but that is a positive from an investor standpoint.
And Sumit?
Yeah, by and large, similar thoughts, except that while China money has vanished, a lot of other countries have started looking at India, whether it is Japan, Greece, and other countries. Plus, the dry powder is fairly high, so it's not a real worry for the companies as such to raise money.
And from your experience in CDC, would you like to add on some of the sort of trends that you saw when you were there?
We didn't compete with Chinese funds at that point, so I know some Chinese investors and they are trying to kind of set up offices in Singapore and invest in India. I'm not taking names. So it is happening in part, but in a small way. But I guess, as I said, the dry powder is still very high. It shouldn't be a problem.
And speaking of dry powder, are we experiencing a slowdown or not? Because the earlier part of the presentations that we had today, even though 2023 was basically a blip in the sort of average, you see that we are returning back to average, or do you feel like we are still in the midst of a winter?
My opinion is that we're still in the midst of winter because deals are taking longer to close. Although the IPO markets obviously have helped in terms of the later stage companies becoming public and others, but earlier stage, Series A, C, B is nothing like what it was in 2023 and 2022 and 2021 probably. But maybe we were expecting 21 and 22 to be the new normal, but this is essentially how, if you remove 21 and 22, then actually this is the normal flows that we used to see, right? But one thing that 21 and 22 did, according to me, although it was a bubble kind of environment, is that it allowed founders to dream big because capital was available and investors were also trying to get them to dream big, which is a positive part, and that has fundamentally changed the nature of entrepreneurship in the country, I think. Hopefully for the good, and that I think. But to answer your question straight, I think there's still some time left before people get back to those. Even 2020, even the normal is still 3-4 months there.
That's my sense too, because I keep seeing down rounds or rounds happening at the same valuation that took place in 21, 22, right? That's the norm. Like people had amazing valuations at that point in time, which is still continuing in 2024, so about much years later.
If you look at SaaS, I think the Bessemer SaaS index is at 6 times or something like that. It used to be 20 times in 21, 22. So, but Indian companies still asking for more than 10, between 10 to 20, but that is the truth. But if you look at the top companies, even the ones that are listed, they're trading at less than 5 times in most cases.
And you had a few thoughts on this.
Yeah,
Similar thoughts. I don't see this as a slowdown. This is just normalization of a crazy few years during COVID, which took everyone by surprise. If you look at the headline numbers, 65 billion or 64 billion is down to half of that. And at early stages, at least last year, it had frozen over. This year, I see some thawing and some action. And that will eventually, cascade through the stages. So I think we're about 6 to 12 months away from the growth investors like us to start seeing, this showing up in the pipeline. For the moment, the other guys have stepped up. So the secondaries guys have stepped up, the IPO guys have stepped up, the pre-IPO guys have stepped up. So I just see this as a normalization process.
And how do you see the secondary market? I know you mentioned the secondaries, because India has been primarily a primary market where people come in, but the secondary market, which is basically happening at a later stage, how do you see that playing out for yourself? Do you see that there are some investors who are just sort of, as part of their strategy, just focusing on secondaries, or do you see that sort of changing, and how does that affect you at all?
So we think secondaries is a huge opportunity. There are actually very few secondaries funds operating out of India. There's few operating out of Singapore and others, but there are no dedicated teams singularly focused on it. And secondaries comes in and solves a specific problem, and especially in a way that they solve a problem at a portfolio level, not just as an asset level. The second is, and you must have seen a lot of these deals, I don't see pure primary deals anymore. It's so interesting. That all of them are stapled with secondaries. And they're stapled with secondaries because it solves the valuation problem. Because people have come in at, like you said, 15, 20x, sometimes 30x revenue multiples. How do you get a company like this capitalized? So you depend on secondaries to do this. So short answer is it's a very, very big opportunity, both at the asset level as well as at a portfolio.
It's a big opportunity because with SEBI also coming in hard on extension of funds, people have to find liquidity for a portfolio, right? But the challenge has been that how do you value some of these assets, because there is so much, can we give a 30% discount, 40% discount, 50% discounts? Nobody, at least 6 months ago, nobody was looking at it and trying to take that call. But now at least there is some sense of, because they've seen about 18 months of performance post-COVID, and obviously they're valuing it, they know the market multiples. But again, whether the fund managers are open to it, our LPs are open to it, is something that is a question mark, right? But that is the LP secondary part where we are saying that, okay, portfolio, somebody wants an exit and we need to provide that liquidity to them. Those funds are now getting a lot more active, because ultimately if the IPO market stays like this and you buy at a discount, there's figuring out that distributions will come early. The second part of it is essentially secondaries where individual portfolio secondaries as well as ESOPs and angel investors looking for secondaries, right? So that market is also quite large and very, very active. If you look at the kind of trade that is happening on Swiggy or NSE, they're actually probably bigger than what the trade is happening in the public markets, right? So the secondary of the illiquid private companies are now become an asset class for HNIs as well, and that is something that is positive as well from an exit standpoint for both the angel investors as well as employees.
Nothing additional except that it's a big untapped market, and the way companies in Southeast Asia, Hong Kong and US have positioned themselves, it's not really happening in India as of now. So when are we going to see it? I find myself no, but if it comes, I think it is an opportunity.
So, speaking of valuation and exits, do you feel like the LPs are concerned about capital efficiency? Because the word that is on the market, especially from all of the global investors, is that Indian companies are valued too high. So do you still feel that? We just spoke about it. Is that still the sentiment, or do you think there's a course correction happening?
No, I think until about a year ago, all VC funds, us included, probably were like, go after growth, doesn't matter how much you earn, because there is money available on the other side of the rainbow, right? but it changed immediately. I mean, it has changed drastically where even the top-notch early stage investors are saying that focus on margins and sacrifice growth, right? So, and I think there is, until 6 months ago, there was always like, I want to do a bridge round, which is something like a discount to the next round, right? That didn't happen in most cases. I mean, as investors, we are looking at pricing around rather than trying to take a 20%, 30% discount to the next round. So valuations have corrected, I mean, obviously because of desperation more than anything else, because you have capital, but it's been 18, 24 months since the last capital raise, so capital has to come. One of the things that has happened is probably some of them have gone into the valuations in the 24 months, so it's not a down round, but it's a flat round, and then there are like secondary discounts plus primary at the same valuation, so that the investor is getting it at a lower valuation. So those kind of mechanisms are happening. But I think valuations, again, see in India, you have to look at it sector-wise. So some of these are hype sectors that were in everybody was chasing at that point in time. But like a pharma for the last couple of years, nobody wanted to touch. But now it's like the hospitals, right? Hospitals, we sold one hospital, about Kim's Hospital, 7 years ago. And after that, now is when the double-digit EBITDA multiples are coming into that sector, right? So each of the sector is different, and I mean the hype sectors obviously are seeing a correction, but the others which were in the dumps now slowly coming into because IPO markets are open and these companies lend themselves very, very well to IPO because they're profitable.
So I think the path to profitability has been the theme, right? I mean, that's what I'm thinking.
More than path, it's profitability.
Just two or three kind of, would you like two or three perspectives on this. One is, by the way, the big story out of India's exits. If you look at the last 3-4 years, our exit story is the silver lining, right? I mean, that is the big headline out of India. We're distributing large sums of money, and LPs have noticed that. It also helps that open market trades and IPOs are contributing to it. So that's, I don't think LPs are worried about it. On valuation, I mean, we've been waiting for 20 years for a value strategy. That doesn't exist in India. So I think we made peace with it. You can be disciplined about not doing something stupid by overpaying, but can you get in a market as intermediated as this, as competitive as this, can you run a value strategy? I don't think so. And across asset classes, public, private, across strategies, India trades at a premium to counterparts globally. So there is, I think we should just focus on what Manga has famously said, that focus on paying up a little for a great company instead of wasting your time trying to get, a bottom of the barrel valuation.
Yeah, just to add there, what the other panelists are saying, and somewhere we have been conservative all along, saying that profitability is important, which was not seen by a lot of people, whether it's investors or companies and founders, over the last 4-5 years. So I think that fundamentals of business do not change, whether it is a VC invested company or you run through your own money. I mean, why are you more prudent when you run with your own money? Can you be similarly or equally prudent if you're taking investors' money, which I have not seen anyone doing yet. And I think that is the fundamental approach difference that I see. Investors are also to blame, by the way, as we go along. But I think creating fundamental business and creating value to all stakeholders is most important. And of course, profitability is important at any point in time. You can argue that companies are getting listed at losses. I don't think I have an answer to that, but fundamentally I think it's important to look at a stable organization as you kind of build it.
And as growth capital investors, do you have any sector-specific sort of focus? Because you feel that you mentioned that you had one, right? But what about you? Do you have any sector-specific focus?
See, typically every private equity fund will knock them in the middle of the night. They will say 4 sectors which will deliver returns for investors. Just healthcare, tech, financial services, and consumer. These are the 4 sectors. Infrastructure, I think everybody's got badly singed by that, and that memory continues to haunt everybody, so nobody's going to touch that. That's the government's domain and the large pension funds domain now. But I think having, one of the things that we strongly believe at Ascent is that having this diversification is key until the market, because the market is still not very deep in each of these sectors. Although, you can deploy capital, but how much capital can you deploy and whether it is consistent is something that is still jury is out. So we believe that given that in a 4 or 5 year commitment period, you catch cycles in which some of them are going through downturns. Basically, make sure that your investing mimics the cycles where you're investing in a down cycle and then exiting in an up cycle. I think that is something that you can take advantage of. The market is very, very hard, but this is like a 6 or 7 year period, right? So you can probably get some benefit of that, because the arbitrage that we as private equity investors enjoy, according to me, is the time frame. We have a longer holding period, and hopefully during that holding period, multiple cycles will come, and even if you miss it because of greed or fear or whatever that is, and there is one more that is always there that we can hopefully correct your mistakes.
We are big believers actually in being sector specialized and being insiders of sectors, and I agree with you, Deepak, that multi-sector strategy works better, not just for the GP and for the fund, but also the market itself has cycles of different lengths. And I'll give you an example. For the last 20 years, we have what I joke about a systematic investment plan in education. And every 2 or 3 years, in good times or bad, we will deploy something in education. And we've been fortunate to have prospered by this strategy. And what this allows us to do is, because we picked a lane and we will invest in education, we can stay out of the market when it's hot. We haven't invested in a single B2C tech company. But we picked B2B bets that have done really well. In 2018, we invested in a B2B education software business, which stands almost alone in a relative graveyard of B2C tech, because it's profitable, it's high gross margin, and it's growing well. And you can only stumble upon opportunities like this if you pick a lane and you live and breathe in that ecosystem. SaaS is similar, financial services is similar. So I think it's very critical for firms to be sector specialized and have a multi-decadal view of specialization.
Interesting. And what about you, sir?
We are a consumer-focused fund, and we invest only in brands, products and brands, and we have a slight advantage of running a business of brands, so we understand a little bit about the whole how to run it perhaps, or build it. Also the fact that consumer brands over a period of time in India have a lot of new brands have grown over the last 7-8 years, and period by funding from VCs. I think, and they've done a fantastic job. The companies who have done, let's say, 100 crores in 4-5 years, which we probably will take much longer. And I think that's a lot of learning that we also try to garner from them. So we continue to be, focused on this sector, which I think also the fact that maybe around 2010 and 12 probably it was all tech funding. I think consumer funding started a little later, but I think people have realized that there is money to be made here. So we'd like to stick to it.
Any other final thoughts before we conclude the session? No? Okay. So we can have the questions from the audience. Please do mention who it is addressed to.
Yeah, hi, this is Vivek. I'm a partner with Sanathan Partners. We are a law firm. The question is to the panel, Deepak, Sumit, and anyone can take it. We spoke about secondaries, and the silver lining of the India growth story has been exit opportunities, right? We saw a lot of externalization happen a few years back, right? Given the regulatory landscape, the changes that we've seen recently, and where the market is, do you see reverse slip as a big opportunity? And if it is an opportunity, how practical stroke complicated it may be for you if you've evaluated for any of your portfolio companies?
So, all our companies are India domiciled, but I can say from just coverage and then understanding of the market, that 8 out of 10 tech startups are thinking of flipping back. And some of them willing to pay large sums of money of tax leakage to do that. So clearly, we were in any way not in favor of externalization. There was no merit to it. You can be a $30 million SaaS company in Delaware, so what? Like even Freshworks struggled to get market attention. And increasingly in the US, if you want to list, you have to be 500 million or more in revenue. So the opportunity is here and now for Indian companies that are, let's say, the 10 to 100 journey, for them to tap IPO markets here. India is open for M&A, India is open for buyouts. This is the market to be. And IT services is a great example of building a multi-billion-dollar business, being domiciled in India and run a global business. So we see absolutely no advantage of moving your legal entity to the US. You can build a global business from there.
Vivek, you wouldn't know the modalities of the flipping and what the paying involved, but I mean, I agree with Imran on the point that, I mean, a lot of them will try and flip because US, the bar is so high, and I mean, in India, probably 100 crores plus. A lot of companies got listed in the last year with 100 crores of revenue as well, at probably 10 times revenue or something like that. But the question is also, what is the exit you're looking for, right? I mean, I don't think even, I mean, foreign buyers, if you're looking for a strategic exit, because today the IPO market is hot, everybody wants to flip back and list in India, or whatever, right? I mean, but if you're looking at a strategic exit, it is still, I would think, far easier to sell a US company rather than an Indian company. So again, it depends on what stage of the company, what is the, I mean, what is the exit mode that you're most likely to encounter. I mean, having said that, we are like Imran, we invest in Indian companies, and hopefully we don't have to pay tax before we realize any gains.
But from what I hear commercially, the premium that the Indian market offers would trump the tax leakage that you're looking at outside.
If it's an IPO.
Yeah.
All right, thanks.
Hi, Sanjay Shukla from Sen Angel. I think related question, it would be good to know your comments from the growth capital perspective about the Gift City and how you view that, no?
Yeah, I mean, we did evaluate Gift City and, I mean, Singapore, Mauritius. These are probably again, it depends on our investors, right? So what our LPs are comfortable with, we are very happy to do. Gift City, I mean, I think a lot of our peer firms have set up entities in Gift City and they're working through it, but we have not found the need for it as of yet. But we have allowed for provisions within our documents to have a Gift City entity if that is what our investors want. So I think it's going to be primarily driven by investors. Until now, we have not faced something where investors are insisting that Gift City is required for us to invest, and they're happy with the older, I mean, because more time-tested structures of either in Mauritius and Singapore, and especially with the new tax regime that is in place, where it is very clear on the capital gains. DTA is almost done with, so we figure that investors think that, I mean, it is a very straightforward structure. They know the structure, so they don't spend much time.
I'm Anubhav Agarwal. I'm a partner with law firm called Bhatia Gandhi. We are at our head office in Bombay. I just have one question, like, in the sense of the whole evolution about the IPO markets, the exit opportunities, and, the funds coming in. How do you see the evolution on the PE/VC markets? Are they now fully matured and open to take majority positions in the companies and then ultimately take it to the IPO stage? Or is it still, sort of earmarked to these one of the bigger funds, etc.? Or more and more now being broad-based in terms of the whole PE/VC sector as well?
So, we think buyouts is going to increase as a percentage of total deals in India. And we've done a fair amount of mid-market buyouts. When I say mid-market buyouts, companies that are roughly $10, $20 million in revenue, and we own 51 to, in some cases, 90% of those companies. The most successful buyout for us has been a company called Eurokids, which is now Lighthouse Learning, owned by KKR. And that was a huge success for us. But we also invested in EI, the education software business that we spoke about, and Sports Village, which is a very unique asset in sports. So we think that this is a huge opportunity because it solves a specific problem in the market. But it requires specialized skills, it requires a dedicated team that has operating skills, and we've worked hard on that over the last decade. We've built a full-time operating team within Gaja Capital that can actually work with these companies. So absolutely, I think we see it as a huge opportunity, IPO or otherwise, as a deal strategy. We see a lot of promise in that direction.
Just to add to what Imran's saying, essentially, see if you're taking majority and trying to do an IPO, maybe the timelines of the fund will not match with whatever we can exit, right? Because India, all said and done, is a pretty unliquid market. But if it's a strategic asset that you're trying to sell to either a larger private equity fund or to a strategic buyer, it does make sense. And I mean, given the kind of valuations that are there in the market today, maybe a platform which you can majority own is probably something that can be built over a 5-7 year period. Exit, I think IPO, while it's possible, but if you own 60-70% of that business, exiting that over a 2-year period or 3-year period is very, very difficult.
Before I tell myself, I have a small question. Yeah, it's a small thing for all three of you to answer. If you can do a very fresh take on, because each one of you, I guess, competes with global other markets that people want to invest. You're somehow patrons of India. You're trying to get funds for India. Then what is each one of your specific take on why you should be a one-line elevator pitch to global players to invest in India? And yeah, I'm Shishir. I'm trying to make private equity scalable with a small search fund called Vasudhaiva Kutumbakam Capital.
By the way, it's not an easy sell. Despite us drinking our own Kool-Aid that this is going to be a $100 billion market. Fundraising is very hard. We spoke about IT services. IT services took 30 plus years to sell India. And on the back of throwing people at the problem, as I said. So we have a tougher job. But our pitch is very straightforward. Our pitch is exactly what we shared with all of you today, that it's a maturing market, it's a mainstream market. Private equity and venture capital only works in large economies. There's a reason why it doesn't work as well in Southeast Asia, or it doesn't work very, very well in smaller economies. You need depth. Now that we have depth and scale of our economy, private equity and venture capital is working and will work over the next decade. That is the most important India pitch. Then there are some embellishments to it, which is policy continuity, which global investors appreciate. They don't like flip-flops. And also a culture of innovation. I think what has changed fundamentally in India, we were always entrepreneurial, right? You just have to, in every street corner there is an entrepreneur. Some of them not by choice because they don't get jobs. But what has changed is the venture capital ecosystem that should get the credit for this. The $100 billion that got poured into India has fundamentally changed the nature of the ecosystem, the kind of innovation. And because the prize money is now material, what I mean by prize money is valuations, it has attracted a new breed of ambitious entrepreneurs and management teams. And this to my mind is a structural changing of orbits. So I'd say that now the pitch is getting a little easier. You're not just selling policy or the scale of our economy or the per capita income. Now you can talk about, you can cite examples of world-beating companies from India. And at least over the next decade, this is a great pitch.
We only pitch to the LPs. If you're an LP with some money, happy to pitch to you on the sidelines. Jokes aside, I think the way to look at it is what Imran mentioned as well. We are always, see, two things have happened which is probably not under our control, but is positive for India. One is obviously China has become, I mean, for whatever political reasons and other reasons as well, there is a large pool of capital that has basically stopped investing in China, right? So now, who's competing with China? We initially thought that the money would go to India and Southeast Asia and others, but there was a lot of talk of that. But if I can put money in the Magnificent Seven or whatever, make 15-20% IRR, we believe we are the center of the universe. Indians believe, right? But truly, in the US, nobody knows India. I mean, India is on par with, I mean, a little bit ahead of Bangladesh maybe, but that is the truth. So, but what has happened is because there are a lot of these exits that are happening and there is buzz and there has to be some capital that has to flow into one of the next bigger, larger markets. There is a lot of appetite to listen and get meetings for us. Whether that is translated into action, still some time, but that I think will happen eventually because the US markets corrects a little bit. Everybody wants diversification, and India is probably where you can actually diversify your holding. Your returns might be similar to maybe a little bit higher than the US market in the long run, but diversification is definitely something, and also the fear of missing out the next large market, right? So we always say that the time to invest in China was 2008, which was 20 years ago, and India, it's current, right? So if you miss this opportunity, then the next 20 years return you'll miss, and then you come back after 20 years, you'll be left with very mediocre returns.
Just to add to what Deepak is saying, I think more from an LP point of view, when we looked at so when we're looking at the LP point of view, I wasn't handling, but my colleagues are handling from London to India. I think India story is very, very strong. So I think, and as Deepak mentioned, I think the fear of one is allocation to India is increasing and going to increase. US funds, Europe funds, they are looking to diversify, and they are certainly looking at India. We also do it as an LP. We invest, or we look to invest in, but we are invested in one consumer fund. And again, it's a question of looking at the quality of that fund, the team and stuff like that. Look at it from that perspective. So I think it's difficult to raise money, but the opportunity is there.
I'm Shafa Kulesi Sapre. I am a managing partner in Chandiok and Mahajan, based in Bombay. I just had a very off-topic question. Really, in this day and age of Shark Tank, everyone pitching for their respective startups. I remember one of my interactions with one of the veterans, Mr. Sanjay Nair, and I helped him for his personal family office investments into some of these kind of opportunities, and he mentioned at one point that it's not just the business, it's also the promoter, it's also the entrepreneur. If nobody believes, but if you get the right positive vibes and you believe in this person, you're ready to invest. You're obviously at a very advanced stage of this cycle. Do you still have those kind of evaluations, or is it the growth capital just comes in from past performance or who's already invested? What are your thoughts on that, please?
First of all, I must say this, that our world and experience is very different from Shark Tank. In 9 out of 10 cases, I'm the one pitching to a good founder. Actually, I should say 10 out of 10, because we are in the business of finding companies that can scale and create value and share that wealth that we jointly create. So oftentimes we are selling. We are on the buy side, but we're selling all the time. So there is absolutely no truth to the Shark Tank, founders coming, pitching, and there is a lot of that drama going on. And not even at the early stages, by the way, because I have colleagues in early stage funds. It's very, very hard to invest. But what do we look for? That varies by stage. In general, you're looking for a good partner who's aligned to your goals. You're looking for a good business with a deep competitive moat, and you're looking for a reasonable price. And this might seem like a bumper sticker cliche, but it's really that simple. And what gets you really good at assessing the 3 criteria is the amount of time you spend in sharpening your sword over long periods of time. A partner selection is about knowing the founder well before the deal is launched. Knowing a business is a function of how deep is how much of an insider are you in that sector? Do you have direct referenceability, 1 degree of separation away from the company and its products and service well before the deal is launched? And your negotiation strategy flows from the first two. You have an edge at the negotiation table if you know the business and you know the founder, you can move fast. They don't value valuation, that's a myth. They value speed, and they want to talk to someone who is empowered and who can take a call with conviction quickly and get on with business.
But in India, still founders matter a lot. They are probably, if you look at it even at growth stage as well, it is very important, at least from an essence standpoint. We call ourselves an entrepreneur-centric firm because ultimately India is not a mature market like the US where the growth stage CEOs can be replaced. A founder can be replaced by a growth stage CEO, and the business is like an Uber still running and doing really well, right? Those kind of instances in India were very few and far between. It is still driven by the founders, but what has happened, which is positive for India, is also that these founders have also gotten a lot better, right? Because they've seen multiple cycles now. They are also open to bringing in professional management and trying to see whether something that is more process and system oriented and not just personality driven is good. But eventually, for the next foreseeable future, founders are very, very important in Indian projects.
Yeah, I think there's no denying the fact that founder comes first. You may have a set of evaluation criteria. Even at growth stage, I think that becomes. At growth stage, probably it's the founder and the management team. But I think that is super critical. I think you're probably putting money behind an individual or set of individuals without right now. Especially the minority investor, what are you controlling? And that comes back to the question of should you have majority and run the company? So it has to be very. We also focus highly on the founder.
Any other questions? There's one at the back there too.
Hi, my name is Ramesh Zara. I am from Apex Group. We do fund administration globally. We spoke about growth capital in India is a selling story to globally. I have a question related to that. There's a good amount of dry powder is available as per the data is showing, and highest ever seen. And US is cutting the Fed rate. Fed rate will be cut down, and the money will come again to India. What as a venture capital or a PE you look for that? You're just waiting for better opportunity, or there are challenges? Are they related to overvalue or returns?
So the question is that what are we waiting for to deploy the
deployment. Deployment is as of now that we're waiting for a deployment.
I think a lot of people are focused on exits right now. So investors want their money back and they're focusing on that rather than investing probably. But I think it is also nature of the investable universe, right? So a lot of funds, again, it's specifically saying there is a lot of dry powder left and might be hard to answer because each fund has its own life cycle, own thought process, own LP challenges or LP pressures. So look at that in that context. And also slowly the market's opening now. I think the founders who are slowly getting to a point where they have only 3-4 quarters of runway are coming into the market, realizing that the 21-22 or whatever 2021 is not going to happen again. I think that is what is bringing some of the deals into the market. And I think deployment has been fairly good in the last 3-4 months if you look at it.
I'll just add to this, there are some macro factors and micro factors. What you pointed out are the headline macro factors, right? And yes, there's a lot of dry powder. And when IPO markets are open up, open market exits are open, secondaries funds are active, it tends to crowd out to some extent, the deployment that you tend to see. But at the micro level, like for example, if you look at us, we've made 25 investments in 20 years. That's our pace. And you know, our biggest deployment year was during COVID, where we saw an opportunity and we deployed 100 million in 1 year. So you have to see this over very, very long averages. A good cycle to see deployment pace at a fund level is 10 years.
And also perhaps I think just to add 2 more points here is that on the micro point is also about at the growth stage the quality of deals available and what suits you. You know, each fund has its own way of looking at deals and their own drivers. I think that one is that, and second there is certainly there is a added caution in taking decisions as opposed to earlier. I think both these things are also probably intact.
Hi, this is Sunita. I'm the founder of Transcend M&A. We are basically focusing on technology sector for M&A transactions in the low to mid market. I have 3 parts question from the panel. Firstly, we have recently, I think a couple of months ago, we have started working with mid-market private equity players in the market who are actually looking at consolidating multiple players in semiconductors and cybersecurity, specifically. I have not seen, many players which are in the Indian market. Most of them are, some technology domain experts who are building and setting up the private equity fund, from start, or they are PE firms from outside India. So that is one observation, like why the established players in the market are not betting on the technology sector, if that assumption is correct. The second is for the companies who are on the intersection of services and products, right? In IT, specifically in cybersecurity, let's say, or IoT, Industry 4.0 services or products. If they are doing like 5 to 10 million in revenues, what are the funding avenues for them? Because that is also one challenge. We have seen that these kind of companies we see that won't even touch. So then, what are the avenues that that will give them, apart from of course the debt financing? So that is the second question. And third would be, how do you see the timeline of technology space maturing to the stage where a lot of PE activity happens in India itself?
By the way, we are open for business, so we have absolutely. Please write to me, imran.jafar@gazacapital.com. We are happy to discuss, either cybersecurity. Semiconductor is a very capital-intensive business, so I don't know where in the value chain we operate, but we'll have to figure that out. But when we say tech, we mean software, but we also interpret this to mean automation, tech-enabled businesses, and that covers at least one of the 2 segments that you spoke about.
Yeah, I mean, you can write to me before you write to Imran. But I think hardware has always been the pariah of VCs and Ps traditionally. But I think given the nature, if you look at some of the electronic manufacturing units that are being set up and others, they are trading at probably 20 times revenue, 30 times revenue, although the EBITDA margin might be about 10-15%, right? So, I think there are funding opportunities available, but again, it depends on the companies. Second part of the question was second question was what? The third question I remember. The third question is, when is tech going to be investable by PE? Already if you look at it, Gaja Capital has invested in a couple of tech companies. We have invested in a couple of tech companies, and these are all, fairly mature companies. One of them that we have invested in is 40 million plus in ARR. The other one is about 20 million in ARR. So essentially, if you look at it, what this lot of money has done over the last couple of years is that it has pushed a lot of these companies upward of 10 million kind of an ARR, which is where at least growth capital starts to become interesting from an investment standpoint. So that will, I think, as the sector matures, I mean, it's already starting, so it's not like it's too far away or anything like that. And in India, like I said, I mean, companies with maybe 25, 30 million ARR can still get listed, especially in the tech sector, especially can show a 75, 80%. It's there already. If you have any deal, let me know, please.
I'll get those things.
Thank you. It was a very insightful session. I would now request the speakers to take a stand for group picture. We will now break for lunch. The post-lunch session will be on growth capital theme with a highly interesting fireside chat between an investor, Stakeholder Capital, and the founder of one of the firm's portfolio companies, Ciclino Healthcare. Please be back for that at 2:30.